Hi again, I'm David Maurice, fee-only certified financial planner with Worthwhile Wealth Counseling.
And I'm Andrew Worley, Associate Advisor here at Worthwhile Wealth. So, David, here we go again this week with value stocks beating up on growth stocks some more.
I know, Andrew, we've been talking about this now for weeks on this podcast and for months in our Common Sense weekly roundup.
And talk about asset classes zigzagging. It couldn't be more obvious and a perfect example of modern portfolio theory, which we use and has won 4 Nobel Prizes, one for the discovery of asset classes. It sounds complicated, but it's just common sense. It's great to see something that's gone up in your portfolio that you have a zig, but you really want something that zagged gone down because that's on sale. And you can sell some of what's up to buy some of what's on sale.
Yep, you're right, Andrew. So looking at last week, all the U.S. indexes for value stocks, large, mid, and small companies, moved up while their growth cousins went negative. This trend's been in place, as we said now, for a long time. We've watched value coming up, zigging, and growth slipping behind, zagging like a seesaw. So small value companies, which ended last year 35% behind growth companies, are now running nose to nose with small growth. Year to date, they're at 13.4 and 13.7 respectively. That's a 35% gap that's been closed in less than 8 weeks. Andrew, I don't think I've ever seen a gap between asset classes close that fast.
It's like watching a horse race. It's been awesome to watch these two asset classes do their thing so perfectly. So having both of these in your portfolio, we can practice what we preach. And so can investors with 401ks and IRAs who have both of these asset classes. They can sell some of their value funds to buy some of their growth funds. That simple act creates a more efficient portfolio, just like a gardener who prunes their plants to stimulate growth.
That's right. If you owned them and you knew it, the very thing that did the worst last year in your account has streaked up ahead with the thing that did the very best last year. And you'd have a simultaneous built-in buy low and sell high signal without any guessing or timing. Like I said though, Andrew, that's if you already own those two asset classes and had this knowledge.
And that reminds me, we need to let viewers know that we are glad to do a portfolio review of your accounts so we can show you how to take advantage of asset classes that you probably have available. We'll show you these ups and downs, zigging and zagging, and asset classes. And we'll show you how that works like a shock absorber in your portfolio and can even boost returns.
Even brings them up.
Who would have guessed that something like this would generate decades of Nobel Prize winning research?
Yes, it sounds so simple and common sense, yet most people have no idea, even though they may have heard terms like asset allocation and rebalancing. They just never realized how simple observations can produce amazing results to reduce risk and actually boost returns.
And the really interesting fact is that most people understand the use of the concept of buy low, sell high in other everyday decisions. It's just rare to see people apply that simple process in their real investment behavior.
We've heard just this year from people who got out of the market last spring only to miss all of this outrageous growth since then.
So remember, the market will work for or against you depending on your use of common sense, useful information, and a long-term strategy.
So we hope we've offered you some encouragement for you to hang in there and use your common sense. It's always an essential part of the best strategy.
Well, that's all our time. I'm Andrew Worley.
And I'm David Maurice, and together we are
the Picky
Pedants
of Worthwhile Wealth Counsel.
See you again.